This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt. To move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Rally ho! Stocks power ahead to new records on the back of earnings and the shoulders of Walmart. So how healthy really are consumers and retailers?
Growth threats. Non-bank lenders have grabbed a huge share of mortgage business, but that growth may be at risk.
And back to the future. As online tools grow, we'll show you why the hottest new organizational app might just be the pen and paper. All that and more for Tuesday, February 21st. Good evening, everyone, and welcome. I'm Tyler Matheson.
And I'm Contessa Brewer. And for Sue Herrera, investors kicked off the holiday weekend style with all three major indices finishing in record territory, helped by earnings and energy. All three are up more than 10% since the election. Today, the Dow, 118 points up to 20,743. The NASDAQ added 27. And the S&P 500 tackled, look at this, ending up 14 points. Energy shares higher thanks to a 1% gain in oil.
And Walmart was one of the key drivers in the Dow today and in stocks in general. Earnings at the world's largest retailer fell in the holiday quarter, but so what? They beat those all-important Wall Street estimates. On the other hand, sales came in a little bit below forecasts, even though they were, get this, a whopping $131 billion. But here's what caught investors' eyes. Same-store sales in the U.S. rose at the fastest clip since 2012, and that is what sent the stock up 3%. Courtney Reagan has more on Walmart's big quarter.
The world's largest retailer had a pretty good holiday quarter. Walmart's U.S. sales, where the bulk of its sales come from, grew at the strongest rate in more than 4 years, and e-commerce is making up a bigger share of those sales. The discounter saw strong traffic in stores, and even though food prices continue to fall, grocery sales were positive, which is important for Walmart as grocery represents more than half of total sales and is a big traffic driver. The discounter did acknowledge sales have been slower than expected to start the year, which it chalks up to the delay in tax refunds versus last year.
I'm positive on Walmart right now. I've had them in the question mark phase. I've said they're doing all the right things, but it's hard to get it to the bottom line. Unfortunately, they're competing with a really, really tough business in Amazon.
Investing in e-commerce remains a top priority for Walmart as it spends billions of dollars to catch up to Amazon online. Walmart says its free 2-day shipping on orders of $35 or more has led to a nice uptick in e-commerce in the 3 weeks since it launched. Interestingly, over the weekend, Amazon quietly dropped its free shipping threshold back down to $35. I spoke to Walmart's Chief Financial Officer, Brett Biggs, and when I asked how Walmart is thinking about a potential border adjustment tax, Biggs explained, "We are pro-tax reform for anything that will help with jobs and help consumers." He went on to say, "We do have concerns that the border adjustment tax has the probability of increasing prices. It is concerning to us." Biggs added, "The devil is in the details, so it's too difficult to speculate on any potential impact. So for now, Walmart's guidance assumes the tax and regulatory landscape stays as is." For Nightly Business Report, I'm Courtney Reagan.
Fellow Dow component Home Depot had a strong quarter, blowing past Wall Street expectations as the housing market remained strong. The home improvement retailer also hiked its dividend 29% to 89 cents a share. That's up from 69 cents. Home Depot wasn't finished there. Nope. It said it's buying back $15 billion worth of shares. Put that all together, and you have shares up 2% to an all-time high.
And now to Macy's and a different kind of retail result. The company's profit fell more than 10%, and its same-store sales slumped, with the company telling investors to brace for another year of the same. Earlier this month, the report surfaced that Hudson Bay had approached Macy's about a possible takeover. But despite the results today, Macy's CEO is betting on the consumer and says his company has to be ready.
Consumers have money, they're spending their money, they're spending it in different places than in stores like ours, in mall-based stores. And they're spending it with us online. But still, at the end of the day, the consumer has the money. Once they've spent their money on these various categories, they've got to be ready to come back to ours. And when they do, we've got to be in position to take advantage, particularly in our stores.
Macy's shares flat on the day.
On Friday, we told you one of the biggest deals ever was close, and now call it a deal undone. Kraft Heinz dropped its $143 billion takeover bid for rival consumer goods giant Unilever. The deal broke up when the offer became public, and it was clear Unilever was not interested in a tie-up. Kraft shares lost about 2% on the day.
And another deal we told you about last week that it might happen actually did. Burger King's parent Restaurant Brands will buy the chicken chain Popeyes for nearly $2 billion. That's a lot of wings. Both companies taking off on the news. Restaurant Brands up about 7% and Popeyes sprinting higher by nearly 20%.
Consumer staple companies, particularly food companies, are having a hard time growing. So they're working on new strategies to find a way to do that. Sarah Eisen is in Boca Raton, Florida, with a look at some innovative approaches.
Big food has a big growth problem. That's why companies from General Mills to ConAgra are rolling out new innovations for longtime household brands to meet changing consumer tastes. Like Oreo and Ritz cracker maker Mondelez, launching a new brand called Vea, no artificial ingredients and GMO-free.
Consumers still want indulgence. I think there's always a sense that, oh, everybody's moving over to well-being. We certainly, on our more indulgent brands, we're continuing to evolve them with products like Oreo Thins, with products like bubbly chocolate, and making sure that we have portion control packages. So there's all sorts of ways to meet the consumer's needs. But at the end of the day, there's no question it is a trend everywhere in the world. And as the world's largest snacking company, we intend to capitalize on it.
Ingredion supplies ingredients to many of these companies and sees the health trend evolving.
What's really working right now? What are some insights you can give us?
People want protein in different ways, and certainly meat protein has been evident in the past. Soy protein has been around. So I think vegetable protein is going to be the next trend where consumers want that in their crackers, in their pasta, in their rice. And we at Ingredion are really participating with our customers to formulate that.
Besides falling behind on big food trends like healthier and fresher eating, companies have grappled with slower growth, both abroad and here in the U.S. And they have yet to see any meaningful boost in spending, despite the strong jump in consumer confidence after the election.
What we see is in the second quarter of the year is usually a difficult time for us because consumers are coming off the holidays. The holiday period, based on our product portfolio, is a huge, huge period for us. So right now we're not necessarily seeing that play through, but certainly, confidence is building, and that helps the restaurant business. Our food service business is starting to gain some momentum. And overall, of course, people are going to be focused more on brands to the extent that they're more confident. That's always good for us.
Companies are also adapting to any potential policy changes from Washington on trade, taxes, and regulation. For the meat industry, for example, China and Mexico are big buyers of U.S. poultry, beef, and pork. So executives are watching nervously, bracing for any heated rhetoric and a slowdown in trade. But despite the growth problems, overall food stocks have been great investments lately. They're considered safe, they pay big dividends, and they've been a hot space for deal making. For Nightly Business Report, I'm Sarah Eisen in Boca.
So what do all of these results from retailers, deal news, and so forth tell us about the state of the consumer and retail today? Jan Kniffen knows. He's the CEO of the retail research firm J. Rogers Kniffen Worldwide Enterprises, and he's with us now to discuss. Let's start, Jan, with Walmart, which has not exactly been a big market participant, a driver of the market until today. How did they get their mojo back?
They worked really hard at it. They've done Retailing 101 pretty darn well. They've got better in-stocks. They've fixed the supply chain. They've made the stores more shoppable. They've actually done what they've been needing to do for a long time, which was just get back to the fundamentals, making the consumer happier. But the other thing they've done is they've done a really good job of getting online. And they've done it without costing themselves bottom line. The biggest problem that we thought they might have was that as they transferred more and more online, that it would cost them at the bottom line. It hasn't done that. So people were pretty excited about that. They had good solid store-for-store sales numbers, and they didn't wreck their earnings to get there. So this looks like Walmart has turned the corner, and I think they were up 29% online. It was a really big number, and that tells you what Jet's doing for them and what their own business is doing for them. That's what they've got to do to be competitive with Amazon.
And they are really giving Amazon a run for their money. In fact, there was news today about Amazon now dumping back some of its costs on those items, what you have to pay on Amazon in order to get free shipping if you're not a Prime member. So Amazon's looking at Walmart with a skeptical eye, but Walmart itself, it's not only seeing a big jump in online, it saw a big jump in same-store sales. How do they do that? What kind of experience do you see that's drawing customers in?
Well, they actually had up traffic. I think the up traffic was like 1.4%. Boy, that's hard to get in the current environment. So not only did they get up store-for-store comps, they actually had more people coming to the store, and most stores are not seeing that. And they've done that because they've made the store a better place to buy. They've got a better assortment of product. They've got much better business in the grocery than they've had in the past. They're doing pickup at the store, drive in, load it in your car in more than 500 stores now. So they've really made themselves much more attractive to the customer, and the customer finally has started responding, which is what they've been waiting to see.
So my sense is that the consumer is pretty healthy. Incomes are stable or rising, unemployment is low, and so forth. But when we were talking, Jan, right after the holidays, we all sort of universally agreed that the mall-based stores and their holiday results were kind of meh. Here you got Walmart and Home Depot knocking the cover off the ball. Take it out a little, broaden it out a little bit. Are others doing as well? Macy's sure isn't.
Well, you know, the two you just named are not mall-based stores, and they're also not dealing in exactly the same space. If you look at people that were dealing in apparel, as Amazon became the biggest apparel seller in the country last year, apparel really got hurt, and apparel's continuing to deflate, where we've seen a slowdown in food deflation. And Home Depot is in another category all by itself, right? It's clearly best in class of what it does, but it's also selling a product where everybody is doing things to their home because we're seeing housing turns do really well. But people are nesting too. They want to do more for the house they're currently in, and they'd rather do that and sit home and order in Domino's than go out and shop. And that's hurting everybody else. So it's great for Home Depot.
Yeah, and by the way, Home Depot is offering that experience to the shoppers too, because they're offering the kids workshops at the beginning of the month. They offer how-to programs for people who come in, and you top that off with the branding and the knowledge, and you're making loyal customers out of the people who might just venture in to see what's there.
And experiential is where we are.
Yeah.
If you can get the customer to want to come to your store to do something, they may buy something while they're there, and that's kind of what we've come down to.
Well, have fun in Las Vegas, Jan.
It's always fun.
It's always
I love
fun.
magic.
See you, man. Jan Kniffen with J. Rogers Kniffen Worldwide.
Earlier, we mentioned Home Depot's massive stock buyback, and while the repurchases generally help to lift earnings, Bob Pisani tells us they're not necessarily a cure-all.
Home Depot had great earnings, but what really moved the stock to an historic high today was the announcement that they were hiking the dividend 29% and buying back $15 billion in stock. That's nearly 9% of the shares outstanding. Home Depot was already what I call a buyback monster. Since 2003, they've cut their shares outstanding in half, from 2.36 billion to 1.21 billion shares. And they're not alone. A lot of companies have drastically cut shares outstanding in an effort to boost earnings. For example, since 1997, IBM has cut its shares outstanding in half. Exxon has cut their shares by 42% since 2000. Big tech names like Intel and Cisco have also cut their shares outstanding by about 30% since 2001. But buybacks are not a panacea for stock growth. IBM has woefully underperformed the S&P 500 in the last 5 years because they've been beset by growth issues. Its revenues from its old line businesses were shrinking, and there wasn't revenues from newer businesses like artificial intelligence replacing it. The lesson here is no amount of financial engineering like buying back shares can replace management's inability to grow the businesses. Home Depot grows their business. The stock goes up. IBM has troubles growing their business. The stock has trouble going up. Buybacks are not a panacea for stock growth. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Coming up, why the president's agenda could be troublesome for the companies that issue most of the nation's mortgages. CEOs of more than a dozen companies, including Boeing, Caterpillar, United Technologies, have called on lawmakers to overhaul the corporate tax code. In a letter to the House and Senate leadership, the chief executives argued a so-called border adjustment tax will make the U.S. products more competitive overseas. This comes following last week's meeting at the White House with the top execs from the retail industry who say the opposite. They say this type of tax would raise their costs and likely prices for consumers.
Canada's foreign minister says any renegotiating of the North American Free Trade Agreement, NAFTA, would be between Canada, the U.S., and Mexico, and not negotiated individually. And as Kayla Tausche tells us, that it's all been NAFTA talk so far.
President Trump's 100-day action plan lists renegotiating NAFTA as a top priority, but it could be months before official talks with Canada and Mexico begin. By law passed in 2015, the White House must notify in writing the House Ways and Means and Senate Finance Committees of a negotiation period beginning that lasts 90 days. The two branches then have that time to set their agenda before the U.S. approaches Canada and Mexico. Aides from both committees confirmed that no such letter has been sent as of this week's recess. Meanwhile, Mexico has already begun its renegotiation clock. The president and his team have met more casually with the relevant parties earlier this month, but a senior administration official says it will pursue the proper channels to renegotiate with Congress once a U.S. trade representative is installed. No hearing yet for that nominee, Robert Lighthizer. In the meantime, NAFTA remains a key pillar of Trump's economic talking points.
We're going to have tremendous trade deals all over the world, but they're going to be bilateral or, as we would say, one-on-one. None of these deals will we get caught in quicksand, where we get mired in and we can't do anything about it, like, by the way, NAFTA and so many others.
Canada's foreign minister on Tuesday struck down the notion that a new NAFTA could actually be two deals, one with each country, saying any negotiations would involve all three. For Nightly Business Report, I'm Kayla Tausche, Washington.
Lumber liquidators post a narrower loss and shares take off, and that is where we begin tonight's market focus. The results easily beat analysts' expectations. The beleaguered hardwood flooring retailer said a rise in same-store sales helped overall revenue top street estimates. The company also said it remains committed to returning to profitability. Shares popped 17% to $17.98. The railroad company CSX said it would cut 1,000 management positions through what it called an involuntary separation program. The layoffs are expected to be concentrated in the company's Jacksonville, Florida headquarter operations, and the company also said its CEO and president are expected to retire at the end of May. CSX shares up 37 cents to $48.91. Shares of Community Health Systems took off today following the hospital operator's better-than-expected earnings and revenue report came out yesterday. Community Health said it has divested more than 20 hospitals in the latest quarter and will continue to focus its efforts on reducing its debt load. Shares soared more than 33% to $9.23.
Self-driving technology company Mobileye has inked another deal with an automaker. Last week, we told you the company signed an agreement with Volkswagen, and today Mobileye and luxury car company BMW said that Mobileye's data generation technology will be available in BMW's 2018 models. Mobileye shares rose 1% to $46.12. Verizon confirmed it would buy Yahoo's core assets at a discount. We told you last week that the two companies were reportedly in talks to revise the takeover price following Yahoo's 2 data breaches. Well, now Verizon said it will pay about $4.5 billion for Yahoo. That is $350 million less than its initial offer. That's my kind of bargain. Verizon shares were up a fraction to $49.43, while shares of Yahoo rose 40 cents to $45.50. And Boeing has received an order from a private Chinese carrier for 5 of its Dreamliner jets. That deal is valued at more than $1 billion. Boeing shares rose more than 1.5% to $175.56.
Wells Fargo has fired 4 of its senior managers as part of the fraudulent account scandal that has rocked the bank since last year. None of those executives will get a bonus, and they will forfeit all of their unvested equity awards and vested outstanding options. The move is part of the company board of directors' independent investigation into the bank's sales practices. Wells Fargo was fined in September nearly $200 million for creating some 2 million fraudulent accounts. And the bank's former CEO, John Stumpf, resigned in October.
Tighter regulation on the banks led to the rise of a whole new group of companies like Quicken and Loan Depot, who grabbed a huge chunk of the mortgage market. But as Diana Olick tells us, if President Trump is able to roll back some of the regulations, those non-bank lenders could feel a pinch.
At a recent meeting with his employees, the CEO of Loan Depot had some sobering words.
Everything that we're doing today, unfortunately, will change.
Anthony Say was talking technology, but he could have said the same for regulation in the mortgage market. The Trump administration has signaled it will roll back stringent safeguards put in place following the financial crisis. Those rules, in addition to billions of dollars in lawsuits and fines, caused big banks to pull back on home loan lending, opening the door for non-bank lenders like Loan Depot, Quicken, and Caliber Home Loans.
In one sense, we really don't want any changes, because what it really does is it creates a barrier to entry. It just makes life more difficult.
For the past 6 years, there has been a staggering takeover by non-bank lenders, especially in government-insured FHA lending. They went from just 10% of new originations in 2010 to half the market today. But if the Trump administration loosens regulations on big banks and stops suing for every single loan infraction, the big banks could move back in, and the non-banks could face stiffer competition. The CEO of Caliber Home Loans, who used to run Citi Mortgage, sees another threat.
I do expect that the regional banks will step up their exposure to lending a lot more, because the U.S. consumer is still very strong, home buying is very strong, and everybody has to show growth for their shareholders and investors.
Whether banks, large or local, move back in or not, one thing is certain: higher mortgage rates will shrink demand for all home loans, especially refinances. And that means all lenders will be competing for an ever smaller pool of business. For Nightly Business Report, I'm Diana Olick in Washington.
And coming up, why the good old-fashioned day planner is back, sort of. We'll explain.
Here's what to watch on Wednesday. On the housing front, sales in January of existing homes are expected to tick higher. As for earnings, one of Wall Street's darlings, Tesla, is expected to release its quarterly results. And the markets will pick apart the minutes of this month's Federal Reserve meeting. That's what's to watch for tomorrow.
Well, at a time when seemingly everything is done online, millennials are starting to schedule their lives in a very old-school way, with a notebook. In fact, sales of traditional journals and notebooks have taken off over the past year, and as Jane Wells tells us, what's old is new again.
This is This Week.
Molly Craven is a 30-something marketing professional who's discovered the hottest new app for organizing her life is a notebook.
I wanted to kind of get more religious and ritualistic about my planning and my list making.
Everything old is new again as millennials are taking pen to paper. They call it bullet journaling. Hundreds of thousands of images have been posted on Instagram, from simple to elaborate. There's even a how-to video.
We keep track of things.
That's Ryder Carroll, an app designer in Brooklyn who has led the bullet journal movement. He says apps like Google Calendar are great, but limited.
And what I really like about bullet journaling, was really important to me, is that it all kind of goes into one place. It's like one tool.
But it's so easy now to schedule your life, go to the dentist, and put down your goals in an app. And if you fail to do something, you can just cut and paste it over to the next week, or delete all evidence of failure. Physically writing something down makes it permanent. It takes more time and perhaps leads to better results. At least that's the idea.
It does give me time to sit down and think about what's coming up and plan a little bit more effectively. However, I don't think I've been doing it long enough to really see the improvement yet.
Even so, sales by publicly traded notebook maker Moleskine rose 12% in the U.S. last year. Ryder Carroll is selling a bullet journal made by Leuchtturm, a 100-year-old German company started back when people used to write. He says there's one other benefit.
The bullet journal, by its very nature of being analog, forces you to disconnect. It forces you not to be online. And that's also really a powerful thing.
However, digital apps do have one advantage. Lose your device and your info is stored in the cloud. Lose your notebook and it's gone forever. For Nightly Business Report, Jane Wells, Los Angeles.
Next up, manual typewriters.
Yeah, I'm not that organized digitally or on paper. I can't do it.
Well,
don't have the discipline.
That's Nightly Business Report for tonight. I'm Contessa Brewer.
I'm Tyler Mathisen. Thanks for watching. Have a great evening. We'll see you tomorrow.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt. To move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.